Assalamu alaikum. Welcome to lecture 10 of AAA. So we have moved to section D of your AAA syllabus. From quality management, we are moving on to audit of financial information. This forms 80% of your AAA syllabus. Section D is the major section of your syllabus. Why? 80% of your AAA syllabus or your AAA exam will be tested on this area. That is audit of financial information. Here we are going to study three parts under one lecture, that is planning, materiality, and the risk, assessing the risk of material misstatement. So first we are going to finish the planning, then the risk assessment, and then the materiality part. So we are going to focus on the exam focus, the audit strategy and the plan. Before you start auditing, remember, there should be a strategy for anything. In fact, any big work if you have to do, task which requires a lot of time, it needs to be planned properly. A proper strategy needs to be there. Same goes for the audit. So we are going to go through the audit strategy and the plan. Then comes the risk assessment. You have to assess the risk. Then the materiality. So from the exams point of view, remember, significant number of marks is there for this risk assessment and planning. Okay, this comes in your section A in your AAA exam. Okay, and for all areas of your exam you have to assess the materiality, not just for this part. Now in your exam, what are you supposed to do? You are supposed to perform a risk assessment for an audit client. You will be told to perform a risk assessment. There are three types of risk that you will be asked in your exam. Number one is the risk of material misstatement, audit risk, and business risk. These are the three risks that you should know, and that will be tested also. Now, starting with audit strategy. First thing that you should know about this is the characteristics of the engagement. Okay, like any engagement will have a financial reporting framework, that is FR framework, because without your financial reporting, you cannot carry on audit. Remember, that's why SBR, if you are planning to give AAA, make sure that you finish your SBR first. Why? Because you need SBR, your financial reporting knowledge, to do your AAA exam. You'll be tested on those knowledge as well. Okay, so FR framework, every audit has this. Next, industry reporting. Whatever industry you are working, they have a specific reporting, they have specific regulations for that. You need to know it. Third, knowledge of the business, very important. Then internal audit function, service organizations, computer assist audit techniques, stands for CAAT, because now everything is computerized, so this will be there. Timing of the audit work, very important. Every audit requires a timing. Are you going to do it for 3 months, 4 months, 6 months? And you should make sure you have the staff, your staff is available. Okay, then next is the significant factor and the knowledge gained on other engagements. First, materiality, very important. Next, assessing the risk of that material misstatement. Need for the professional skepticism. Remember, as an auditor, you have to be professionally skeptical. You have to challenge the views of the managers or the ones who are responsible for corporate governance. That's your job. You cannot accept everything on the face value. Okay, you need to challenge opinion. Internal control has to be there, because without sound internal control, audit cannot be planned. For evidences and all, auditors need to rely on the internal control, and it should be sound. Significant development affecting the entity. Whatever developments are there which is affecting the entity, as an auditor you should know it, you should have a knowledge of it, because this is going to affect your audit. Changes in laws and regulations. You might say laws is not something which you should know. It is something that a lawyer should know. As an auditor, you should also be a part of the law. You should know any changes in the law in that industry which you are auditing. It's going to affect the audit. Changes to accounting standard. Yes, This is your IFRS and IAS. You should know it. So these are significant factors an auditor should have a knowledge of. Moving to 3, reporting objectives, timing and communication. Under here, you should have a timetable for reporting. When are you going to report? To whom do you report? Communication with the client. You should always communicate with the client. Communication among the team. Then communication with third parties. Nature, timing and extent of resources. The fourth one. The selection of audit team. The budget. Every audit team has a budget. Okay. Now, once the strategy has been established, you plan. Okay. Remember, the plan is more detailed than strategy. All these 4 steps that we have went through, they are just a strategy. They are general. They are not very specific, but detail is very specific and detailed. So these are the descriptions of a plan. Okay. What should be the nature? What should be the timing, extent of risk assessment procedure? If you have to do a further audit procedure, what is the nature, timing, extent? Like what audit procedures you have to carry, who should do the audit procedures, how much work should be done, like how much sample size should you collect, when the work should be done, should it be interim versus final, and any other procedures to conform to ISA, that is International Standard of Auditing. Okay. Both the strategy and the plan, remember, they have to be formally documented in your audit working papers. It is not just word of mouth. It has to be documented. Now comes the planning procedure for a new audit client. Okay. Almost the planning procedures are same for recurring audit and new audit client, but there will be some additional for new audit client. Okay. You need some more time for new audit client because there are some things which is you have been introduced it for the first time. That's why. But once you are familiar with your client, some steps are reduced. So for an initial audit, there are some factors you need to consider, like arrangements, okay, which should be made with the predecessor auditor to review their working papers. You have to work with the former auditor and review their working papers. Next, matters which are discussed with the management in connection with the appointment should be considered. For example, any significant accounting policies you have to discuss. Why? Because it can affect your plan audit strategy. Then, audit procedure that are necessary to obtain sufficient appropriate audit evidence, especially for opening balance. Okay, this is dealt according to ISA 510. Initial audit engagement, opening balances. It should be planned. Then quality control procedures will be there. Okay, and this is increased for initial engagements, remember. Okay, for example, when you're taking a new client, you will involve another partner also to review the overall audit strategy. Before you commence your audit procedure, before you start your audit procedure, you hire someone else, you involve someone else along to review. And even if you are complying with quality control review and all, that also should be documented as well. In fact, in audit, everything is documented. Okay, just remember it like that. Next, in addition, okay, the previous ones are done for the recurring audit also, but when it's for new audit client, these are addition. Addition is what? Time and resource. In the first year of an audit for a new client, you need more time as well as more resource. Why? Because you need to understand that client. You have to document the internal control. Remember, first year, once you document the internal control, then later on you don't have to, because you know the internal control already. You have studied it. But first year you need more time because you have to understand the internal control. You need to understand the industry. So you have to document that for the first time and understand the business, like legal and the regulatory framework of that industry. Next, in the first year of an audit for a new client, you cannot put so much reliance on analytical procedure. to collect your audit evidence. Why? Because before you rely your reliance on analytical procedure, you need an extensive knowledge and experience of the client. Analytical procedure is what is basically a relationship between two variables. It's like ratios. But to understand, first you need knowledge and experience. So analytical procedure you cannot apply for the first time. Maybe you can put reliance on observation or inspection of the client. But what you can do in the first year is you can increase the test of detail. All this test of detail and all, you might know it from your AA, that is Advanced Audit and Assurance, ZRAF level. Because we have not yet went through the test of details in our AAA. It's yet to come. Okay. Now, remember, when it's an initial engagement, you are taking a new client for the first time and you are auditing it for a new client, risk is more. Okay, risk is more. So because risk is more, what should you do? You should hire or you should get along with experienced audit team so that your detection risk is reduced. Detection means what? Risk of detecting material misstatement is high in the first year for a new client because you don't have lack of understanding and experience. That's why you have to hire an experienced audit team who is experienced in that industry to reduce the risk of detection. Now, so planning and strategy is done. Second is risk assessment. Once planning and strategy has been done, then comes risk assessment. Remember this order, it follows an order. You cannot first do risk assessment and then plan and do strategy. No. First first strategy and plan, then risk assessment. Okay, so the next one is risk assessment, next part. According to ISO 315, okay, all auditors have to perform risk assessment procedure, all auditors. So how can you do that? You can inquire your management. Okay, maybe you can inquire your internal auditors if there is an internal audit function. And also you can ask others who might have relevant information about your client. Okay, you can inquire about external and internal changes the company has experienced. Second is analytical procedure to identify trends and relationships that are inconsistent with other relevant information according to the auditor's understanding of the business. Third way you can assess the risk is through observation. You observe the control procedure. And the fourth is inspection. You inspect the key strategic documents and procedural manuals. So these are the 4 ways and we are going to go through in this 4 ways in depth. Okay, first, inquiries of management. These are the examples, okay, that you need to do. For example, have any share issue occurred during the year? You can ask your management this question. This tells a lot about your company's finance. How is it financed? Is it through shares or is it through debt? Because if it's through debt, it's going to be more financially risky. Gearing will be high. Has the company invested in new capital asset during the year? This shows whether your company is growing or not. Has a new competitor or market entered the market? Because if new competitors are there, if it's highly competitive, you cannot enjoy a high gross profit or net profit margin. Okay. How does the company manage exposure to exchange rate risk? These are the questions you can ask your management, through which you can see the risk, how risky the company is. Then, has there been any change in the senior management during the year? See, no one wants to know how many employees has changed in the middle level or the lower level. But senior management, yes, because it has an impact on your risk. It's going to be more risky. That's why. Next, analytical procedure. Analytical procedure is more like comparison between two things or ratios. Okay, understand it in simply like this. Don't go by the sophisticated word and assume that it's a very tough thing. Okay, just think it's a ratio or just comparing two things. So you can compare your actual result to the forecast to see any significant differences. If there's a significant differences, it shows it's more risky and you need to figure out the reason. Next, client's performance with the industry performance. client's information to the previous year. Or you can calculate some key ratios from the financial statement also and compare the prior year with the this year to see any significant fluctuations or not. Because this could be an indication for misstatement in the figures on the financial statement. If you see the ratios are very unusual, then it's a sign to worry. You can analyze it more in detail. Next, observe. You observe how control is applied. Let's say during inventory count, how the controls are applied. Or when you are doing a year-end reconciliation, bank, the supplier statement, to ensure they are performed regularly. You observe. How monthly end adjustments are done, you observe it. How? Let's say you are doing an interim visit to ensure that controls are not only applied at the year end but throughout the year. Inspect. You inspect these things. You look at the organization charts to identify changes in the key staff or examples of controls operating throughout the year. For example, evidence of review of month end reconciliation, or evidence of review of aged receivables on a monthly basis. Then you can have the HR record or payroll record to identify movement in staff. Whether staff are leaving or most staff are joining. News and media report. This will tell you any significant issues regarding any legal action, if there might be some legal action against the company. Then board minutes. For any significant events or transactions during the year that create a significant risk of misstatement. Okay. Now, analytical procedure and data analytics at the planning stage. See, we told analytical procedure we use at the risk assessment, but analytical procedure could also be done at the first stage, that is planning stage. Okay. Why? Because it is a relationship. Analytical procedure can give a relationship between financial and non-financial data. Some firms can use audit data analytics software also to perform this analytical procedure, and give the results in a visual format, which makes your work very much easy, right? Compared to you doing it manually for each variable. It's very easy and fast also, doing it through a software. So at the planning stage, an analytical procedure may be performed using management accounts or a draft financial statement, if available, okay? And it will be useful also at the planning stage because you can identify any unusual fluctuations or balances which are not consistent with the auditor's expectation. So that these areas indicate risk of material misstatement. So from early only you can plan and you can change your plan accordingly through analytical procedure. Now, in your exam, you may be provided with the financial information, okay, and expected to perform analytical procedure as a part of risk assessment. Okay, you could be asked to do that, or you may be provided with the results of the analytical procedure from the auditor's data analytical software, and you might be asked to interpret the results to help you with your risk assessment. So either of these two you could be asked in your exam. Make sure that when you are practicing questions on this area, you try to do both the questions. One where you are asked to perform the analytical procedure. The next one, results is already given of analytical procedure, you now have to interpret. Okay. Let's go through an example of analytical procedure. So here you have been given two examples. Okay. One is of inventory, example 1, and example 2 is of journal testing. Okay. So I will take you through both the example to see how we can use data analytics at the planning stage. Okay. First one is regarding stocks in the fashion industry. Okay. Where they order stock 2 times, one for the spring summer range and the other one for the autumn winter. Okay. So today is July 2005, okay, and the final audit takes place in October, okay. Then they tell when they purchase for the spring summer and when they purchase for autumn winter, okay. Now you have been given the following analysis of the inventory by age and inventory by value of inventory by age and value of inventory by, this is the inventory value, okay, with the days. They have given the days also here, okay. So here if you see value of by age, okay, value of inventory, this is just the value of inventory, okay. I don't know why it's been 2 times, okay, it's not this, okay. This has been copy pasted 2 times, that's why you have to look from here. Sorry for the misunderstanding, okay. Value of inventory by age. So here you have been given the value starting from 0 to 25,000, okay. And this has been, and on the horizontal axis, x-axis, you have been given the age, okay, that is in days. For example, this is 0 to 60 days, 61 to 120 days, up to we have 365 plus, that is more than a year, okay. This much information is given. Let's say this is your exam and in your AAA this much information is given. Now how do you interpret this information? That is your challenge, okay. Now, so this is the answer, interpretation. This is what you have to do in your exam. Let's see how they have interpreted. This is a fashion industry, understand, okay. And they order it 2 times. One is for spring summer collection, the other one is for autumn winter, two ranges, okay. So they are taking 0 to 180 days. They are not taking one by one, okay. They are taking this up to this days they are taking and interpreting it. Why? Because whether it is for spring or summer or whether it is for autumn winter, at least 6 months they take, okay. It stays for 6 months. So inventory within this aging categories relate to spring summer and this one, and therefore valuation is unlikely to be an issue as sales will still be occurring for the spring summer 2005 inventory. So you have to understand when the inventory is taking place, okay. It is July and this one, okay. So here you can go through the dates, okay, at least 6 months. So they'll be having both, okay, in this where they'll be selling. Here valuation will not be an issue. Why? Because sales will take place. This is that range where they are going to have the categories for spring summer as well as autumn winter. Both ranges will be there, and still sale will be occurring for spring summer 2005 inventory. Sale of this range will take place during this time, during the 6 months period. So there'll be no issue in the valuation. There should be no issue. So this area is not likely to be risky. Now moving on to this, only this specifically, 181 to 240 days. Okay. Inventory within this aging category is still likely to be sold at the unusual selling price until September 2005 when it will be discounted, because they told that this time this will be discounted. Here you can read this first few lines, okay, that the company will discount any unsold inventory from spring summer range in September 2005. That comes after 6 months, right? That's the reason. So here it will be likely to be sold at the usual price when it will be discounted, until when it will be discounted, usual selling price only it will be sold. So here auditors should include audit procedures on the valuation of this inventory at the final audit stage in October 2005. For October 2005 they have to value this, Why? Because any unsold inventory will be discounted. And if this one is lower than the cost, the remaining inventory should be written down. It's a risk area. And remember, you always have to talk in terms of materiality, how material something is, okay? So here, it is unlikely that the inventory will be sold, even at discounted prices. The inventory should be written off. Because I mean, see, when you come to this age, 181 to 240 days, who wants this selection? Who wants the summer spring clothes at that time? It's going to be too late, right? Then because then winter collection is coming up. So even if you give discount, who is going to buy it? It's unlikely that they are going to purchase it even at discount. They don't want those clothes, right? That's why you have to write off this inventory, because this is a fashion industry. Fashion industry quickly it replaces out. The fashion goes outdated very quickly. So even if you give heavy discount, you cannot sell those inventory in the winter collection. So as inventory within this age category represent 15% of the total inventory value. This could be a material audit risk. This is what you have to do in your triple. You have to find out how did they got 15%. You have to do working here. Okay. How you are going to do this? Add up all this value. Okay. For example, by this thing, the values add up all 19642 plus 18681. This values, okay, this values you have to add up to find the proportion of this over the total. 1089 plus 8065 plus 5047, whatever the total you're getting. Okay, you have to find this one, 8065, 181 days to 240 days, we are in that category. So 8065, we want to see the portion of this over the total value. So you will get around 15%, 15 point something or 14 point something, round up to the whole number. So around 15%. So it's material, right? So inventory in this category represents 15% of the total inventory. It's a material audit risk. This is how you interpret. You have to calculate ratios. Now we are moving on to 241 days plus. That means all this. Okay. So this two are 0, nothing to talk, only this one, 5047. Now we are going to do it the same way. Cancel this and take this and find this proportion. You'll be getting 9.6, but they are taking a round figure, 10%. Okay. So here, inventory older than 248 days is unlikely to be sold, and you should write off. There is no chance you're going to give discount at this time. At least less than 241 days, you can give discount also, even if it's unlikely to be sold at that time also. But here, you're not going to give discount. So you write off this inventory. And if you go, as we have calculated, 10%. This is also a significant audit risk. An auditor should bring this issue to the attention of the client so that in your financial statements, you do a proper valuation of inventory. Okay. So that one was for inventory valuation. Now we are moving on to second example, that is journal testing. Okay. Here, if you go by the volume, 70% is automated, 30% is manual. And if you go by the value, 90% is manual and 10% is automated. And here you have been given the top 5 users by value. If you see, this two are highly valued, M. Davis and T. Smith. Okay, and M. Davis is a payroll clerk and T. Smith is the finance director. This both. Okay, now we'll see. So volume by journal processed in a year is 23,659. Value is 548,020. Average journal size is $23.16. If you see, it's very small. And journals above 5,000 processed is just 12. So now we are going to interpret this. Okay, remember there are a number of concerns if you go by this. If you see, the average journal size is very small. It's just 23.16. Okay. Remember, if this is due to automated journal, then it's not a concern. But if it's a manual journal, okay, it's an insignificant amount. Okay, for insignificant amount, it suggests inefficiency. Why? Because why to post journal for a small average size, right? Amount is insignificant, then it's inefficient, right? If you go by the average journal size. But remember, the manual journals are more significant to the audit compared to automated journal. Why? Because manual journal have a higher chance of fraud and error. You can easily change and alter them. And if you go by this pie chart, okay, 90% is manual, which should be of your concern. 90% is manual, whereas if you go by the value, it's 90%. But if you go by the volume, manual is only 30%. It's less by the volume. Automated journal is not our concern because risk, fraud and error taking place in automated journal is highly unlikely compared to manual. That's why we are working on manual. Remember, in audit, whichever represents higher risk, we talk about that in answer, not the one which has insignificant risk. Okay, that's how you understand what we need to answer. Now, that's how we analyze also. So if you see the processing of large journal by the finance director, why finance director? See this. T Smith is the finance director and T Smith has this much. M David is the payroll clerk. If you go by the volume, both are above 5,000. Even this is above 5,000, but it's very little, 5092, and the rest two are less than 5,000. So not of our concern. Only the first two is of our concern. Okay, this is not unusual if you go. Why? The who has done the processing of large journal? The finance director. It's not unusual because finance director is the one who will do processing of large journals. It's his job. But auditor should still review those journals, even if it's done by the finance director, especially if there's a risk of deliberate manipulation. But what about the payroll clerk? Remember, the payroll clerk is the highest. Okay, if you see this, M Davis is a payroll clerk and M Davis is the highest. He has processed journal the highest. So the journal processed by this one is a greater concern, as there's no obvious explanation for this, that why payroll clerk is processing the journal. There's no clear explanation and it is the highest amount. So this should be of a greater concern to you because this is the area that could represent fraud, even though there might be legitimate explanation, right? For example, payroll clerk might be tasked with processing monthly journals for statutory deductions. And remember, there are only 12 journals above 5,000. So if you go by the individual value by T. Smith or M. Davis, this must be very high. Just see the value. 143,986, very much above 5,000. Even this 42,187, it's very high. Okay. Understanding the entity. The auditor is required to obtain an understanding, okay, of this. So, what is this entity? We need to understand the aspects of entity and its environment. Okay. How complex is the organization structure? Why? Because more complex the structure is, the higher would be the risk of material misstatement. Next, auditors need to have an understanding of the ownership and the governance. Okay. Who is the owner? Who is the manager? Who is those charged with governance? Then the business model. Okay. Not only just the business model, but how the business model integrates the use of IT. Does it have a multiple legacy of IT which are not integrated well? If it's not integrated well, it will increase the risk of material misstatement. And also you have to check whether IT systems are outsourced to a third party or not. Again, it increases the risk. Then auditor needs to have an understanding of the external factor, the industry and the regulatory. The measures that are used internally and externally to assess the entity's financial performance. and auditors need understanding of all this. All this components together makes up the environment of an entity. Okay, the organization structure, the ownership and governance, the business model, the IT, the regulation of that industry, and measures internally and externally used to measure the financial performance. Now, under this understanding of entity, we have more things, that is the financial reporting framework. So auditor needs to have an understanding of the financial reporting framework and whether the entity's accounting policy is consistent with those financial reporting framework or not. Next, components of the internal control and whether there are any control deficiencies or not. So in your exam, okay, if ever you are told to understand an entity, you have to see two things: the financial reporting framework and the internal control. Now, components of internal control. Once you have understood the environment, now it comes to internal control. This comprises of 5 things, and we are going to study these 5 components separately. First is the control environment in the internal control. Then the entity's risk assessment process, the entity's process to monitor those internal control, information system and communication and control activities. Okay. First, we told that we are going to understand entity through its applicable reporting, financial reporting framework. Okay, that part is over. Then we told internal control. So in that internal control, these are the 5 components. Okay. Now, one by one we'll go. First, starting with control environment. This is the first important thing. Okay. This basically is control environment means the top level. How the top level people are viewing the control. For example, the auditor may consider how management has responded to the findings and the recommendations by the internal audit regarding any internal control deficiencies. Let's say there's an internal control deficiencies and your internal auditor has informed you of that. How you're responding to that is what control environment is all about. Because the environment is set by the top level people, the key people in the organization. How they view the internal control. Are they responding to it? Are they taking any actions? Are they supporting corruption or bribery? Okay. Do they have tight sound control? This is what control environment is all about. Next, the auditor must also assess whether any control implemented as a result of those recommendations are subsequently evaluated by the internal audit function. It's not just enough, it's a two-way thing. Once, internal auditor will inform you of the deficiencies. Second, internal auditor will again check whether you have implemented those recommendations or not, whether you have worked upon those recommendations suggested by the internal auditor or not. Next is the entity's risk assessment process. Okay. So, auditor must identify the business risk that is relevant for financial reporting. Okay, and how those risks are addressed. They must also evaluate whether the process is appropriate to the entity's circumstance or not. The risk management process forms the basis for how management determines that is to be managed. And remember, when we're talking about business risk, remember 3 types of risk in the beginning of this lecture I told you. What are the 3 risks? Business risk, audit risk, and risk of material misstatement. So out of that, business risk is those business risks that are relevant to the preparation of financial statement. Only that business risk auditors are interested, not the entire business risk. Any business risk that affects in your preparation of financial statement is of interest to the auditor. Now, if there is any change, okay, changes in these things, these variables can affect your risk. Risk will arise due to changes in these things. What is it? Number 1, regulatory change. Any changes in regulation, laws will change your risk. Then changes in the personnel, that means the key staff, will alter your risk. Information system, risk will be there. Technology, changes in technology alter the risk. Products, changes in organization structure, changes in accounting requirements, and changes in the use of IT. All this, changes in any of this will change your risk. Now, entities process to monitor the control. Okay, for example, client's continual process of evaluating the effectiveness of controls over time. It is not just one time activity. Continuously, client has to keep on evaluating how effective the internal control is. Why? Controls keep changing over the time. If you keep the same control that you kept 10 years back, it will not be effective in today's time. You have to keep on updating the control. Okay. Next, monitoring the internal control. Monitoring of internal control is whose function? It is the internal auditor's function. Do we have internal auditor to monitor the internal control? You have to see. Then information system and communication. Remember, this procedure is applicable for both manual system as well as computerized system. Okay. For example, how transactions are initiated, recorded, processed, and then reported. It follows this. It needs to be initiated first, then recorded, then processed, then report. How accountability of assets, liabilities, and equity are maintained. How incorrect process of transactions are resolved. Okay. Now, process and account for system overrides. Transfer information from nominal to general ledger. Capture information, relevant information. Okay. Capture information that is relevant to financial reporting for other events and conditions. Ensure information required to be disclosed is appropriately reported. Okay, the auditor can use automated tools also. Why? So that they can understand the flow of transaction, how the transaction flows, how it is processed. All this will help the auditor to understand the information system. Next, auditors can have a direct access to the database of the client. Okay, this will help them to understand how information is initiated, processed, and reported. Now, third, control activity. Okay, these are the control activity. Whether there's an authorization to confirm the transaction is valid or not, whether there's a reconciliation so that a transaction is complete and accurate. Verification, you need to verify. Someone needs to be there to verify whether a transaction is complete or accurate. Then there should be physical or logical controls to prevent any theft to data or assets. Then segregation of data has to be there so that any fraud is prevented. Okay, because when you segregate duties between 2-3 people, there the opportunity to commit a fraud or an error reduces. Okay, now understanding the entity's use of IT. You need to understand IT very well. Why? Because the risk arises from this area, like unauthorized access to data. What are the risks? Unauthorized. Someone might have an unauthorized access to data. Okay, they might come and change the data. Next, possibility of IT personnel having access beyond their privileges, which might not be necessary for them. Then, unauthorized changes to data in master files. We have some more. Unauthorized changes to IT applications. Failure to make necessary changes to IT applications. Inappropriate manual intervention. Potential loss of data or inability to access those data as required. All these are risks from IT. Now, we know the risk. What about the control? These are some general IT control, which is divided into three parts. First, you manage access. How? You might give each user their own credentials. Okay? Or you can make sure that users only access information that is necessary for their responsibility. They are not given the wide access. Then authorization of access for new users, and you remove the access from your former employees. You control to recertify access over time and have a control over the physical access to hardware and data center. That is, you manage the access. Now you can manage program or other changes to IT environment. For example, if there is any change that is taking place, let's say from manual to IT or from one system to another, control has to be there. Second, segregation of duty during that change taking place. Controls over system development, acquisition or implementation. Control over conversion of data during that development part. Now, managing IT operation. Okay. Controls over job scheduling, job monitoring, backup and recovery, intrusion detection. Intrusion detection means warning signal will be given if an unusual transaction is detected or something, right? You can read about it on Google. For example, if your stock level falls below a certain level, or if there is you're suspicious of uh, let's say change in data, and if someone tries to change that data, warning signals will be given in the system. That is known as intrusion detection. It is detected. Now, information processing control. This control is when information is processing. Okay, it is during that time when you are giving information in the system. You can have a batch total control, sequence check, matching master file with the transaction record, arithmetic check, range check, so that something falls within that range. If anything outside that range, system will not accept it. Authorization of transaction entities, exception reporting, automated three-way matching. You match your order with the dispatch node with the invoices. And software tools which validates, which automatically checks the formula, the macros. Okay. Now, so third is materiality. So from risk assessment, we are moving on to materiality. We first started with planning and strategy of audit plan. Then we moved on to risk assessment. Now the third part of this lecture, the last part, is materiality. Okay. Now, the objective of an audit. What is an objective of an audit? It is to express an opinion, a true and a fair view. Okay, that financial statements gives a true and a fair view regarding material aspect. So that's why you have to take care of materiality. You have to give importance to this materiality. Okay, because any misstatement, let's say you have omitted some information. This omission could be material if it's individually, or if you aggregate it with some other information, can affect the decision maker. Okay. Now, calculation. This is very important, which you need to remember throughout your AAA. Here they have used some benchmarks for you to decide something is material or not. So here, if it's a pre-tax profit, and if it's between 5 to 10%, it's material. Okay. If you are going by the revenue, just half to 1% is considered as material. And total asset, 1 to 2% material. So in your exam, you need to calculate this. What ratio is it? If it's revenue, if it's within half to 1% is material. Something more than 1% material. Something beyond this range, less than this range, is not material, immaterial. Okay. Now, in your initial assessment of materiality, you have to use these benchmarks initially. Later on, you can make judgments. You have to make judgments. to reassess the materiality. Remember, the materiality changes. Initially, what you considered material might not be material later on. Here you have to use a judgment. Now, calculation. So when you're deciding on an appropriate benchmark, auditor have to consider this few things. With calculation, few things matter. Just don't look at the figures in isolation. The quantitative threshold, there are some things. For example, look at the elements of the financial statement. Look at the particular items that could be focus of the user. The nature of the entity, its life cycle and environment, the ownership and the financing structure, the relative volatility of the benchmark. All this needs to be taken into account when you are taking just the figure. Now, material by nature. Some item, even though it might not be material by the number, by nature it's material. Everything is not just finance. You have to take care of financial. Sometimes you have to see the nature also, which is not financial, right? Examples. Any misstatement that could affect compliance with regulatory. Any misstatement that could affect compliance with debt covenant. Any misstatement when adjusted could change a profit into loss is material. For example, if you have to comply with the debt covenant, keeping your borrowings less, right? And if you misstate that figure, it means you are breaching the debt covenant. Then it's material. Even if you misstate something and it's not breaching your debt covenant, means it's not material. You understanding? Same goes for the regulatory environment. If you are complying with your regulatory rules, and if you're not complying with the regulatory rules, okay, it could mean you will have to give penalty or something. So it's material by nature. Because if you're misstating, you are showing that you're complying with the regulatory requirement. It's a misstatement. And if you correct the misstatement, that means you're breaching the regulatory laws. The rules and regulations is material. Now, let's say your net asset position. Okay, when you adjust your misstatement, you correct your misstatement, your net asset position becomes a net liability. It's material. If you're having a related party transactions with director, it's material. Because directors have a huge salary and benefits in kind, or even personal use of assets. These are material. And disclosure in financial statements regarding possible future litigations or going concern issues, then it's material by nature. Remember, in this condition, numerical calculation is not relevant. You might say in terms of revenue, it's not material if you go by the calculation or by net pre-profit tax or by asset. But by nature, going concern issue, future legal claims, these are material. So you have to take care of it. Now we'll be moving on to material by performance. Performance materiality. Okay. So it is unlikely that in practice auditors will get one individually material misstatement. Usually misstatement occur. Misstatements are material when they are aggregate. When many misstatements are added together, it becomes material, right? So for this reason, what auditors do, they consider performance materiality. What is this performance materiality? This means auditors set the materiality level at less than the materiality that they have set for the overall financial statement. Why do they do this? So that they can reduce the probability, okay, that the aggregate of the uncorrected or undetected misstatement exists materiality for the financial statement as a whole. They reduce this probability. That means when you're aggregating misstatement, it should not be more than the materiality that you have set initially for the financial statement as a whole. That's why they set that materiality, that is known as performance materiality, at a lower level than the materiality that has been set for the financial statement as a whole. Okay, definitely with questions we are going to understand this performance materiality better. Okay, in the next lecture we are going to do question on this lecture. Why because this lecture itself is going to be around 3 hours. Okay, the question answer session will take another 2 hours, so the video becomes 5 hour, and I know no one is going to watch that lengthy video. Okay, so I thought of dividing it into 2 sections. Question answer of this lecture will be in the next video. So there we'll be going through all materiality, performance materiality and all. Performance materiality, briefly, performance materiality will be less than the overall materiality. It should always be like that. It cannot be more than the materiality that has been set for the whole financial statements. Okay. Now, risk of material misstatement. So now we are moving on to the risk part. Okay. Risk of material misstatement is the risk that financial statements are materially misstated before the audit. Okay, that means financial statements are materially misstated. Now, there could be 3 reasons why financial statements could be materially misstated. Why? Number 1, numbers. There would be overstatement or understatement of those numbers. For example, receivable. Okay, let's say overstatement of receivable due to bad dates not being written off. If you're not writing off the bad date against receivable, your receivable will be overstated. So, financial statement is overstated. It is misstated. Overstatement or understatement means misstated. Okay. Second way could be disclosure. Maybe disclosures are inadequate or missing. For example, going concern disclosures are not given. So again, financial statements are misstated. Third, the basis of preparation of your financial statement is inappropriate. For example, you are having an issue over going concern. There is an uncertainty. Okay. Then you cannot prepare your financial statement using going concern. It should be made up on a breakup basis. So if this is inappropriate, again financial statements will be materially misstated. Now, when evaluating the risk of material misstatement, it is crucial to discuss the specific impact of risk on the financial statements. Very important. Examiner will ask you. This is a very common question. What is the impact on the financial statements? What is the impact on the financial statement? So now we'll go. First, impact is whatever your specific account balance or transaction, that means your statement of financial position or statement of profit and loss or any disclosure gets affected, are affected. Second impact is how it is or may be misstated. That means what the client has done wrong or what the client could do wrong when preparing financial statements. You have to take care of those things as an auditor. What could go wrong? Then, whether the item could be overstated or understated or omitted or inappropriately recognized, etc. Okay, in the financial statement, something might be overstated, something might be understated, something might be not given at all, something might be recognized but it's inappropriate. So, risk of material misstatement compromises inherent and control risk. There are 2 terms you need to know. 2 types of risk. Because of this 2 type of risk, there is a risk of material misstatement. One is control risk, the other is inherent risk. Okay. First, let's go through inherent risk. Inherent risk means, okay, inherent risk will be there. Every organization have risk. You cannot bring the risk to 0%. Right? There will be some risk which you cannot avoid. Unavoidable risk will be there. That is inherent risk. Okay. So no matter whatever you do, there will be a risk of material misstatement. Okay. And this inherent risk is usually taken before you apply any control. Okay. Before any related control, what could be the risk? Now, it could be quantitative as well as qualitative. Okay. Inherent risk factors. Now we'll go through some qualitative inherent risk factor. For example, the more complex the organization, the more the inherent risk will be. Subjectivity, the most subjective. For example, if you have to make accounting policies which are very subjective, risk is the inherent risk will be high. Change, when you're changing something, inherent risk is there. Uncertainty, higher the uncertainty, higher the inherent risk. and susceptibility to misstatement due to management bias. Okay. Now, financial statements could be materially misstated if they are not prepared according to the accounting standard. Okay. In order for the auditor to identify this material misstatement, okay, you need to make sure that appropriate accounting treatment is followed. Okay. So in your exam, you need to comment on whether the accounting treatment has been complied with or not. That's why when you're sitting for AAA, you need the knowledge of SBR. Without SBR, you cannot pass AAA. It's very unlikely you can pass. You can't. There's one chapter in your textbook of AAA, which we are going to cover later on. The name of the chapter is Financial Reporting Revision. It summarizes all the key points from the standard. Make sure that you go through this if you have time. But anyway, I will be covering it in my upcoming lecture. Not now, maybe at the end, towards the end of the audit, towards the end of my lectures. We have a long way to go. Now, inherent risk, we'll take examples. Okay, we'll take elements and we'll go through that. Elements from the financial statement. Okay, so revenue. How inherent risk is there in the revenue? Okay, if you know SBR, you know IFRS 15. Okay, anyone who is giving AAA exam, it is assumed you know IFRS 15. I mean, all the SBR standards are there. So IFRS 15 is one of them, which is revenue from contract with customer. Okay, remember in IFRS 15 there are 5 steps to recognize revenue, right? And one of those 5 steps was to determine the performance obligation in the contract and when they are fulfilled. That is the time you recognize the revenue, right? See, some transactions is very easy for you to recognize revenue. Why? For example, for goods, some goods, when you purchase the goods from a shop, okay, the performance obligation has been fulfilled at that time only when the customer takes the good. So you recognize the revenue when the customer gets the good. But some contract, it's not straightforward. Especially when it's a contract to fulfill something over a period of time, over a long period of time. Or the contract has variable consideration, transaction price. For example, if certain targets are met, okay, this much will be the transaction price for the contract. Okay. That's why in this case, the revenue recognition becomes a bit difficult because you don't know whether certain targets will be met or not. You have to wait for the future. Today, you cannot recognize revenue. And if the contract is for a long period of time, you can recognize revenue only when the contract is fulfilled. Let's say construction, you have a contract to build a building, let's say over 3 years. So the revenue you can recognize after 3 years, right? So it makes revenue recognition difficult. Because it makes revenue recognition difficult in this case, what happens? Risk of material misstatement increases. Remember, whichever the area is more risky, more difficult, that area needs to be audited more. Why? Because risk of material misstatement is in that area. That's why I've first taken revenue. If you see AAA, in your AAA exam, revenue recognition is the most important. 80% of the risk is in the revenue recognition compared to all the other parts. And then we have obviously foreign currency, financial instruments. Why? Because these are complex areas. Easy things, risk will be less. So we don't have to worry so much. Why? The risk will not be material. But revenue recognition, yes, risk is going to be material. Second, impairment. Let's take impairment. Okay. So according to IS 36, which talks about impairment of assets, how do you recognize impairment? In case you forgot your SBR, you need to revise a bit. Go back and revise. Also, by the way, good news is I have my SBR lectures. It's completed. You can use it for June, the upcoming exam. It's there under my SBR lecture playlist. You can go watch it in case you want to revise your standards. You can always go back to SBR and check. All my lectures are out there and all the standards are there. Okay, even IS 36 is there, so you can go and watch. So anyway, let me tell you briefly. IS 36 impairment of assets. How do you measure impairment? It is the carrying amount and the recoverable amount you compare. If your recoverable amount is less than the carrying amount, then there's an impairment. Okay, and recoverable amount, how do you measure? There's two methods: fair value less cost to sell or value in use. Whichever is lower, that will be your recoverable amount. Okay, but to measure that recoverable amount, you need to make an estimate that how much will be the benefit of that asset, right? How much benefit you are expected to generate by the asset in the future. This is an estimation. You require estimation here. So this is subjective and easily it could be manipulated also. So because it is subjective and easy to manipulation, it increases the risk of material misstatement. Can you see when impairment is a risk of material misstatement area? All these are inherent risk. No matter whatever you do, you will be having some asset which are impaired. You will be having revenue recognition issues. So these are inherent risk. Okay. Third, provision. According to IS 37, provision. Okay. You can recognize provision when there is provision, liability, and an expense if there is a present obligation. Present obligation to for an outflow of economic benefits. For example, let's say assurance type warranty provision is there. Okay. When you're giving an assurance type warranty provision, management has to use their expertise. They have to use their judgment here. So because management is using judgment, it's very easy that they could be biased. Why? Because they might want to show less of a liability and less of a cost so that they can show their financial performance better. You see? So this also has a high inherent risk. Next, assessing whether a risk is material. First, you identify there's a risk of material misstatement. Once you know, you need to understand whether the risk is significant or not. This is done during the risk assessment process. Okay. So let's see. How can you tell whether risk is significant or not? These are the factors. Number one, look at the transaction. If, okay, the transactions for which there are multiple acceptable accounting treatments, such that subjectivity is involved, the risk will be significant here. Why? Because if something only has one acceptable accounting treatment, everyone will go by that one treatment. So you know how that transaction is recorded or how it is treated, right? But if there are multiple, you don't know which one. So easily management can choose which one is best for them. So subjectivity is involved here. So the risk will be significant here. Obviously, the risk will be there if they only have a single accounting treatment also, but risk will be less. Here it's significant. Second, accounting estimate. So you have to see in your exam whether transaction is complex or not, accounting estimates are more or not. Okay, where you require high estimation or complex model, risk is significant. Third, there is a complex process in collecting data. The more complex, the risk more significant the risk will be. Account balances or quantitative disclosures that involve complex calculations. Wherever you require complex calculations, the word you see complex, that means risk is significant. It's a hint for you. Accounting principles that may be subject to differing interpretation. Again, risk is going to be significant here because it could be easily manipulated. And changes in the entity's business. That means you are changing the accounting. For example, mergers and acquisition. Here also this will be significant. Now, when risks are considered to be significant risk, once you know, identified, see there will be, let's say 5 risks are given. Not all the 5 risks are significant in your exam. No. Maybe 2, 3 or 1. You need to identify very clearly which one is the significant. Once significant risk has been identified, then comes the response. How do you respond to it? Number 1, you evaluate. You have to give these responses in your exam also. Okay, evaluate the effectiveness of control and address the significant risk. How effective is your control? Second, perform test of control in the current period so that you know how effective your control is. Third, get more persuasive evidence, especially for the high assess risk where the risk is higher. Communicate with those charged with governance about the significant risk, and take this significant risk into consideration when determining what key audit matters. Remember, in your auditor's report, there is a section called as key audit matters. There you are going to talk about this key significant risk. Next, timely review the audit documentation. Okay, audit documentation. Who is going to review this audit documentation? The engagement partner. Okay, so timely review of audit documentation by engagement partner to allow significant matters to be resolved before the auditor's report is signed. Significant risk is a significant matter. Then for group audit, you need to involve group engagement partner if the significant risk relates to a component, and the group audit team must direct the work directed to be performed by the component auditor. The group audit team should tell the component auditor. Component auditor means, let's say, for out of 6, for one subsidiary there is an auditor, because in that the risk is high. That is known as component auditor, an auditor for one subsidiary. Okay, because component means it's a part of a group, right? Subsidiary is a part of a group, same. So that is known as component auditor. So group audit team will tell the component auditor how the work should be done. These are the response. Why? It reduces the risk. It helps to address the risk. Now we are moving on to control risk. Inherent risk is over. Next is control risk. Control risk is a risk that misstatement that could occur will not be prevented, detected, or corrected on a timely basis by the entity's control. It says even though control is there, still you cannot prevent the risk from happening. You cannot detect. They might fail to detect. They might fail to prevent, or they might not be even able to correct the misstatement on a timely basis. There's a risk. That is known as control risk. Even though entity has the best control, okay, they have designed the best control in the organization, still there is a very high chance that control might fail to prevent a misstatement from happening, fail to detect, or fail to correct. That is known as control risk. Okay, inherent risk before you apply control. Control risk comes after you apply the control. Still there will be risk, even though it's less, but still. So if the client's internal control are not effective, whatever the transactions you have processed might be of error or fraud, and hence misstatement. Now, examples of control risk. Okay. Now, a lack of segregation of duties. See, think about control. When you have segregation of duty, that means you are having a control. But when there's a lack of that, then there's a control risk. Okay, lack of segregation of duty. That means only one person is taking care of the cash. One person who's receiving the cash is the one who's recording the cash in the system. So he could easily commit a fraud. Why? Because he have that opportunity. And system will not be able to detect that fraud also. Understanding? Next, purchase orders. If purchase orders are not authorized, a purchase order being placed for a non-business use is unlikely to be identified if it is not authorized. If the purchase order is for a non-business use also, through the system you cannot identify. Third, customers. If customers' credit are not checked and there's a no limit has been given to the credit, then what happens? Company could carelessly make sales on credit to uncreditworthy customer, which could lead to irrecoverable debt in the future. Now, moving on to audit risk. Go through this diagram very carefully. This is what you need to remember throughout your AAA. That audit risk compromises of two risks. One is risk of material misstatement. The other one is detection risk. Risk of material misstatement we have just covered. Detection risk we are going to cover now. Risk of material misstatement further comes down due to two reasons: inherent risk and control risk. Both we have covered. So, audit risk means that there's a risk that auditors might give an inappropriate opinion about the financial statements. They might not give the correct audit opinion. That is audit risk. Now comes the detection risk. What is detection risk? Detection risk means auditors, through the audit procedure, even if they have done the audit procedure, they will not be able to detect some material misstatement. That is known as detection risk. Okay. Now, detection risk is the only risk, remember, only element in that diagram that auditor can have a control over. Auditor can change it. They can increase this risk or decrease this risk. It is in the hand of the auditor. But the other two, that is inherent and control risk, is not in the hand of the auditor. It is with the client. Right? Because it comes with the preparation of the financial statements. And who prepares the financial statements? The client. So, detection risk includes situations such as, these are the situation. Number one, first year of auditing, especially when you're auditing for the first time, a new auditor, a new client, sorry, auditor might have a lack of knowledge or experience in that industry. So this might increase your detection risk. That means there is a high chance that you might not be able to detect in the first year of the audit because of lack of knowledge. Second could be when client is putting you pressure to finish the audit in a short span of time. Again, this will increase your detection risk because a lot of things might go undetected because they're rushing the audit. Third, client which operates in multiple sites. Okay, and especially if the auditor is not able to visit all the site during that audit period, then what happens is in some site where there's a material amount of inventory that is held in those site, and if auditor have not visited that site, then you might have overlooked the inventory. So inventory would be misstated. So if no detection risk is given in the scenario, that means in your AAA exam, if nothing has been mentioned about detection risk, then please understand audit risk will be equal to risk of material misstatement. They are same. Why? Remember the diagram? Audit risk takes two things: risk of material misstatement, detection risk. But if there's no detection risk, then that risk of material misstatement is only the audit risk. They are equal. Now, detection risk can be reduced by these things. Number one, emphasizing the need for professional skepticism. What is professional skepticism? We are going to cover that as well. Okay, a little bit later. Every auditor needs this skill. Okay. That means you are challenging the management. You are having a questioning mind. You are being alert. That is the meaning of professional skepticism. There is more to it, but briefly, this is the definition. So you become more skeptical. Rather than accepting everything and being naive, you are now challenging the management. So this will help you to reduce your detection risk. You might be able to detect material misstatement faster. Second, keeping more experienced staff, especially in the complex and the risky area. Third, change the nature or the extent or the timing of the direction. And also, who is going to supervise, who is going to review the work performed. You can change all this. Then, incorporating additional elements of unpredictability in the selection of further audit procedure. Changing the overall audit strategy. Sometimes you might have to change the overall audit strategy itself. Example, the auditor's determination of performance materiality. Performance materiality we have covered earlier, right? Setting a materiality at a lower level. The auditor's plan to test the operating effectiveness of control. And the nature, time, and extent of substantive procedure. All this comes under audit strategy, which you can change and reduce your detection risk. Business risk, even in AAA, this will be asked. Okay, but what is business risk? First understand. Business risk means, okay, due to some negative event happening, it is having a negative impact or adverse effect on your business. It could be anything, due to some significant conditions or events or some circumstances or some actions or inactions that will harm or that will be an obstacle for an entity to achieve its objective. That is known as business risk. And auditors have to assess this business risk. Why? Number one, this helps to develop business understanding. Second, increase the likelihood of identifying specific risk or material misstatement. If you assess the business risk, you will be able to understand the risk of material misstatement also. Why? Business risk. Some business risk can have an impact on your financial statement, and hence financial statement means material misstatement will take place. It helps to evaluate the overall audit risk. We'll see now how. So the relationship between the business risk, okay, and the risk of the material misstatement or audit risk, they are same. What is the relationship between business risk and audit risk? As I told you, many business risks will face financial consequences. Okay, that means they will have an effect on the financial statement. So anything having effect on the financial statement, understand, means there's a chance that financial statements could be materially misstated. That's why, hence, it will affect the audit risk. Okay. Now, examples of business risk and how it creates to material misstatement. You need to understand this link. In the exam, obviously, you don't have to show the link, but understanding will help you understand and explain business risk better. Then, link. Changing legislation. See, changing legislation is a kind of business risk. Okay. So when legislation are changed, let's say maybe they might have introduced some fines or some penalties for non-compliance. Okay. So if the company, if the client does not account for this fine or penalties correctly, financial statements will be materially misstated. Second, decline in the demand due to the change in the public opinion, fashion or technology, whatever. So because when demand declines, what happens? Sales revenue also decline. Okay. So a decline in demand may result in net realizable value falling below cost and inventory may be overstated. Third, price war that are initiated by the competitor. All these are business risks. But see how it is leading to material misstatement. So this will result in your sale price being reduced. So when your sale price reduces, what happens? Net realizable value falls below cost and inventory is again overstated. So inventory overstated means material misstated, right? It is misstated only. We have some more. Excessive reliance on the dominant CEO. What happens? This can result in fraud because they can easily falsify the accounting records, and this could be a material misstatement. Overtrading. Overtrading means you're expanding too fast. Too fast. So this will lead to cash flow problem. Your gearing might increase. That means your increasing financial risk. You might be relying on just few products or few customer supplier, or even failure to innovate also. So what happens? All these are business risk, but all this might lead to going concern issue. Okay. So because this lead to going concern issue, and if you're not disclosing it appropriately, that there's a going concern issue, then what happens? There's a material misstatement. Okay. Now we'll go through example. Sometimes you need additional information to plan the audit. Yes, in your exam you might be given some information, specific information from scenario, but it's not all. Sometimes you need additional to understand. Example 1, purchase of shares during the year. How this can help you in audit? So let's say client have purchased 25% share. Okay. According to SBR, tell me if it's 25%, just looking at the percentage, how it will be accounted for. It will be treated as an associate. Why? More than 20, less than 50%. Right? Correct, no? But there might be no significant influence that is exercised. Could happen. Maybe by percentage wise, if you go, yes, it looks like an associate. But still, no significant influence can be exercised. What happens? If no significant influence is exercised, it could be treated as an investment. That means according to IFRS 9. IFRS 9 rule applies that time. That's why. This is the reason you need additional information. Regarding what? How voting rights are attached to the shares. Through this, you will understand whether significant influence has been acquired or not. If significant influence, it's an associate. If no, then it's an investment. That means IFRS 9 rule applies. That is financial instrument. Example 2. Taking a new loan during the year. Okay. Let's say client has taken a 10-year loan. So normally, it is expected that loan will be divided into two sections, current and non-current liabilities. But if there is no payment due in first 12 months, the entire amount, the loan will be a non-current liability for the first year. Okay. So in this case, what happens? You might need some additional information. For example, the loan agreement will help you. That could be an additional information. So through loan agreement, okay, you can understand what are your payment terms, what the details of whether the loan is secured over the company's assets or not. Also, this will help the loan to be split between current and non-current. Okay. Example 3. No, I think it's just 2 examples. Okay. So now you might need additional information to help with your analytical procedure. For example, revenue. What happens? See, your financial statements gives you very summarized information, but you need detailed information to do this analytical procedure. For example, revenue. They might just give you one revenue, the total revenue, but that revenue might be comprised of many different things. For example, you need to break down this into groups, the revenue, into classes, so that you can perform the analytical procedure. For example, you can break down the revenue by customer, by the geographical location, by the product, so that it's easier to identify the unusual fluctuations rather than just looking at one revenue figure. You can see which geographic region revenue is very high or very less, by customer which customer is giving us 80% of the revenue, which is 20%. So you will understand. You can do analytical procedure. Next is cost of sales and operating expenses. This also you can break down according to the type of expense. Payroll cost. So if you break down the payroll cost according to department or month, it's easier for auditor to identify material misstatement. Now, professional skepticism. This is a skill every auditor needs, and in fact, not only auditor, every profession needs it. But mostly, it is highly recommended for auditor. Okay, professional skepticism definition is an attitude that includes a questioning mind, being alert to conditions which could indicate possible misstatement due to error or fraud. That means you're critically assessing all your audit evidence. So remember, professional skepticism, this is both an ethical as well as a professional issue. Ethical issue as well, okay? Professional skepticism usually means you are maintaining an independence of mind. In your mind, you are independent. You are not biased towards, or you are not influenced by anyone. Okay? So in your exam, you may be required to critically evaluate the planning or the performance of an audit. You will be asked, and remember, this carries major marks, okay? 70 to 80% of your AAA marks is in this area. That's why the auditor has to exercise professional skepticism. Now, professional skepticism requires the auditor to be alert to number 1, audit evidence. that contradicts the other audit evidence. Sometimes it happens. One audit evidence is saying something else. When you collect it through the others, it's saying something else. They are contradicting with each other. Here you need to apply professional skepticism. You need to challenge why it's different, why it's not consistent. Second, information that brings question about the reliability of the document. And also responses to inquiries to be used as an audit evidence. Sometimes you might inquire your management, your client, and the response that you get might be questionable, whether you can use it as an audit evidence or not. So here, professional skepticism is required. Third, an auditor needs to be alert is conditions that can indicate possible fraud. Circumstances that suggest the need for new audit procedure in addition to those required by ISC, that is International Standard of Auditing. Now, examples of circumstances where professional skepticism has not been applied. Number one, contradictory evidence has not been questioned. Let's say you have got contradictory evidence, but you are not questioning. So you are not applying professional skepticism. Second, you are not challenging the reliability of documents and responses. Third, you are not seeing whether evidence is appropriate or sufficient. Also, the authenticity of document is not considered. So it could lead to possible fraud. Past experience, let's say there's a past experience that your client is lacking integrity or dishonest and you're not taking it into consideration now, which is not good. And auditor is accepting less persuasive evidence. Why? Because in the past they came across this client and they are saying they are highly honest. So because they were honest in the past, you are assuming they'll be honest now also. That's why you're accepting less persuasive evidence now, which is not good because you are lacking professional skepticism. Now, if professional skepticism is not exercised, the auditor may do this thing. Number one, they might overlook unusual circumstances. Now, do you understand why professional skepticism needs to be practiced? If it's there, chances of material misstatement will be less because you will not overlook unusual circumstances. You will not use unsuitable audit procedures, nor you will reach inappropriate conclusions. That's why professional skepticism needs to be exercised. So, auditor must obtain audit evidence at the risk assessment stage. That also in an unbiased manner when you are taking these evidences. Okay. So, for example, this will help you to identify the potentially contradictory information, which can then indicate risk of material misstatement. Okay. And remember, when you're taking evidences, it has to be from relevant as well as reliable source. And make sure that you take the evidence from multiple sources rather than relying on one source. Get it from multiple sources and check whether they are consistent with each other or not. Now, approach to exam question. This is the most important thing. Why? Because this risk of material misstatement, this area, this lecture, in fact, is so important. 80% of your marks comes from this area. And you're definitely going to get a question on this with the professional marks in this area. I think it's first question in your AAA. That's why so much importance has been given to this lecture. That's why even how to approach this question in your exam has been given here, which is going to help you. Question and answer will do it in the next video. But at least the approach is given here. So risk evaluation. How do you evaluate risk in your exam? First, audit risk and risk of material misstatement. Okay. If you are asked to use analytical procedure, this is how you do it in your exam. Okay. You first have to do calculation and present them in a table. You can use Excel for this. Okay. For example, let's say this is how you have to do your analytical procedure. Basically, it means ratios. You can see gross profit margin increased from 2004 to 5. Interest cover reduced, effective tax rate reduced, receivable collection increased, inventory holding period reduced. Okay. Now, if you are asked to use analytical procedure, this we are under the same thing, then understand for each calculation it's half a mark. Okay, and this question could be up to 5 marks only for calculation part. Okay, remember no marks are given for wordings, sorry, for workings or writing on formula. So don't waste your time on writing formulas or doing workings. Only calculate ratios and trend that are relevant to evaluate the audit risk or risk of material misstatement. If your ratios does not give you the risk of material misstatement, don't calculate that ratio and waste time. Remember, marks will only be awarded when the calculations are used within the risk evaluation. So don't waste your time calculating ratios that you are not going to refer to your risk evaluation. You need to refer it in your answer later on. Now, let's say you have been given the results of analytical procedure. Now, you need to evaluate the risk of material misstatement. So for evaluation of risk of material misstatement, up to 3 marks is there. Each risk is worth up to 3 marks. And if you want to get the full marks, you have to explain each risk. It should not be too brief. It should not be too much. If it's too brief, you are losing out important marks. If it's too much, you are losing out time on the other questions. And remember, some risk could be 2 marks also. You cannot write so much detail on those risks. For example, let's say for a new client, detection risk will be higher. Why? Because you don't have a knowledge of that client yet. Now, to ensure that your answer is detailed, you have to use this approach. Number 1, identify information from the question that is given to you, scenario that creates this risk. Next, if numbers are given, check whether balance is material or not. This will help you whether risk is significant or not. And you have to state the required accounting treatment according to the accounting standard. Here you need SBR knowledge. This is for any question, in fact, on risk. This is how you need to go in this order. First, identify information that can create risk. Second, if numbers are there, see whether it's material. Third, state the accounting treatment. Okay. And in case your exam, in your case study, specific information has been given about the accounting treatment, comment on that accounting treatment. It has to be there in your answer. Now, state the risk to the financial statements. Once all the 3 steps has been done, and this needs to be done in the order. You can't change the order. You have to state the risk to the financial statement. If the required treatment is not followed, what could be the risk? For example, whether the balance will be overstated or understated. This is what examiner is actually asking you. Okay, let's go one by one. Let's see some terms, elements of financial statements, and we'll walk through it. Let's assume we are doing a question on this and now you are answering. Receivable. How do you evaluate the risk? Or material misstatement for receivable. This is how you do. Remember the 4-step approach. First, identify the information from the case study. The risk is there. For example, major customer. If there's a major customer and they are struggling to pay their debt, what happens? Receivable will be higher than the last year. Okay, receivable will be higher this year than the last year. Because they are struggling to pay their debt, they have not yet paid their debt. If they have paid their debt, only receivable reduces, right? Otherwise, receivable will increase. So this is an area of a risk you have identified from the case study. What happens next? Number. Let's say a number is given. So the balance outstanding, let's say, is 5% of total asset. As the assumption, okay? 5% is significant. It's material, sorry, 5% is material. Because it's material, risk is significant. Now, because risk is significant, state the accounting treatment. Receivable. What is receivable? It's a financial asset. Understand, receivable is a financial asset. So financial asset is dealt according to which standard? IFRS 9 financial instrument. It says how receivable should be measured at the transaction price less allowance for expected credit loss. If in case you forgot this, you need to go back to my SBL lecture IFRS 9 and revisit this. It's depth, it's explained in detail there. Here you don't need it in detail, but at least know this much. And fourth, overstated or understated. So because of this risk, what happens? Receivable will be overstated. Receivable is overstated, will be also be overstated if the dates are not written down. This is how you answer. Exactly these 4 steps. First, identify information. Second, check whether material or not. Third, state the accounting feedback. And fourth, whether it is overstated or understated in the financial statement. Now, the way we have done for receivable, we are going to do it for foreign currency transaction same way. First, because everything is bought from the overseas supplier, it's a foreign currency transaction. It's a risk. Second, according to IS 21, see, nothing has been mentioned about materiality, so we skip that. So according to accounting standard, IS 21 deals with it. Okay. Because it's a purchase, it's an income statement item. You can use either average rate or spot rate, the date when purchase have taken place. Okay. And any payable has to be revalued at the year end. So what happens? What is overstated here? If remember this error is not corrected, what happens? Purchase will be misstated as well as payable if payables are not revalued at the year end. Third is share-based payment. Under share-based payment, let's identify the risk. Risk area is, okay, company introduce a cash settled share-based payment. Remember, it could be either equity settled or cash settled. Again, you need to go back to my IFRS 2 lecture in SBR and watch this. If it's cash settled, okay, and let's say no amount has been recognized in financial statement, it's a risk. Second, which standard? IFRS 2 says because it's a cash settled, you recognize a liability and an expense. So liability, let's say, has to be recognized as the fair value. This is according to IFRS 2. Okay. Now, both expenses and liabilities will be understated. Why? Because if you're not measuring it, okay, let's say first point it says it has not been recognized in financial statement. So that means you have not recognized an expense and a liability. So they are understated. Provision is another area. Okay. So let's say client has this year started offering warranties with products sold, but no provision has been recognized for it. What happens? According to IS 37, you have to recognize a provision when there's an obligation. Okay. So according to this case, sale of goods with an assurance type warranty creates an obligation. They have to either repair or replace the goods returned with the warranty period if they are not performed as expected. So obligation is there. So you have to recognize the provision, liability and expenses. Because they are not recognized, they are understated. Financial instrument. During the year, let's say company purchased 200,000 shares at cost, but fair value is 250,000. You see the difference, 50,000. Okay, and if you take the difference, you see of your total asset, this represents 1.5%, which is material. So according to IFRS 9, because this shares, okay, you could either measure this at fair value through comprehensive income or fair value through profit and loss. Let's say this is at fair value through profit and loss only. Okay. So here, any increase or decrease, okay, will go to profit and loss or other comprehensive income, depending on what you are measuring your fair value at. Sorry, shares. Shares are measured at fair value through profit and loss. So any increase or decrease in the value will go to profit and loss only. Okay. when you're measuring the shares at the reporting date. Okay, and shares that are valued at cost in the statement of financial position, okay, means both your profit and cost are understated because you have not recognized it in your investment or profit, the 50,000. So it's understated by 50,000. Government grants. Let's say government grants represents 5% of total assets. This is material. Okay. If you go, remember I have presented you a quantitative threshold table to say whether this is material or not. If you take it by pre-tax profit or assets, or I think I forgot, but yeah, one is profit, one is asset. So if you go by total asset, 5% is material, right? 1 to 2%, I think. So 5% is material. IS 20 says grant should be recognized as an income over the period. If you are taking the grant for 2 years, let's say, so over 2 years you have to recognize this grant as an income. So if this amount is not recognized as an expense, sorry, as an income, it should be deferred to the statement of financial position and released to the profit on a systematic basis, that means over the period. So here what happens? There could be a risk that the grant could be immediately recognized in full in the current year. So in the current year, your income and profit might be overstated and your deferred income might be understated. Now, evaluating the business risk facing the client. This in your exam, if it comes, how do you evaluate? You have to see which business risk is affecting your financial reportings. If a business risk is not affecting financial reporting, you don't have to worry about it. You can ignore it. But in your exam, you will be only given, most of the time, business risk are given which affects financial reporting. Otherwise, what's the purpose? Right? That means those which could lead to material misstatement. So when you're explaining business risk, what should you explain? It is a risk to the director and they should care about it. So basically, focus should be the adverse impact on either the profit, either the cash flow, or either the revenue. Okay. Here also, identify the information from the scenario that creates this risk. Second, once you have identified, explain the impact on the business operation. Third, financial impact. Explain the financial impact. Financial impact means understatement, overstatement. Okay, here also we'll go through example. Let's say one business risk is major customer. Okay, major customer is struggling to pay the debt. This is a risk, business risk. What happens? Because of this, customer cannot pay their balance. So customer will not receive cash, which reduces cash inflows. What happens? Debt will need to be written off, which will reduce profit. And future revenues will also decrease. Why? As major customer will no longer be trading with the client. If your major customer is struggling with the debt, you will not do any more business with them. So you are losing a revenue also from them, future revenue. So cash inflow reduces, revenue reduces, profit reduces. Note. This note is there with every item, okay? The risk of material misstatement is that receivable will be overstated here if you are not writing off the irrecoverable debt. Okay? So this does not need to be given in the explanation of the business risk, but it should be considered when deciding whether business risk is one which the auditor will be concerned about or not. Second, foreign currency transaction. Here, company purchase all goods from an overseas supplier. That's why it's a foreign currency. Okay. Here, if the company is not using any hedging instrument, hedging means to minimize the risk by taking forward future option and all those things. This I've explained in my AFM, Advanced Financial Management. Even AFM lectures are there on my YouTube channel. On the playlist AFM lecture, you will get it. Right? So if the company does not use any hedging instrument, To expose that risk, you'll be exposed to a foreign currency risk. This can affect the price of the purchase, and hence your purchase will be higher, which will reduce your profit. Okay, so here the risk of material misstatement could be foreign currency purchase or sales might not be translated at the correct exchange rate, or even receivable and payable might not be translated at the year-end exchange rate. Now, professional skills and behavior. I told you these are your 4 professional skills that will be tested in AAA: communication skill, analysis and evaluation, professional skepticism, and commercial acumen. If you have taken SBL, you know what each of this means. But most of you take SBL as a last paper, so you have no idea about the skill. No worry, we'll explain one by one. In this case here, we'll focus on communication skill. Why? Because this paper, this question, risk or material misstatement, under this they test your communication skill. This is the professional skill that they test in this question, for this question. And your professional skill marks is 10 marks. Okay. So here the professional skill is communication. Only this will be tested. So here you'll be asked to prepare your answer in a briefing note. That's why it's a communication skill. Communication means basically, are you carrying the format? If they are if the question asks you to prepare something in a report, are you preparing it in the format of a report with proper subheading, heading, introduction, conclusion, sending the address, to, from, subject, date, all those things. Okay. You might be asked a briefing note. Then, so when you're evaluating audit risk and risk of material misstatement, which are not business risk, what happens? Professional marks will be given according to the prioritization of risk. Remember, how are you prioritizing your risk? This you can be achieved 2 ways. One, you are stating the risk given in your answer in the order of priority. Okay. Or you are giving a conclusion including the most significant risk. In your ACCA website, you need to go there, go to AAA and go to your technical article and read this. Okay. Under your exam technique for AAA, part 2 risk, please go and check. This gives you the exam technique for evaluating risk. Make sure that you read your technical articles, by the way. Okay. For each subject in ACCA, you need to be up to date with your technical article. That reading part, you have to do it. That is to understand the material better, and if any new information comes, it is always updated in technical article. Now, relevance of the information provided. The scenario. Sometimes they will give you all the risk. Okay. And remember, the scenario is quite detailed. You might become very bored of reading too much information. But in AAA, you have to sit and read all those. That is the challenge. That's why AAA is very difficult to finish it in the time. Too much of reading. Okay. So you have to evaluate the information. All the information, because you have to plan the audit. Okay. This question comes in the planning part of the audit. First question. So the information given to you will be given in number of exhibits, not under one exhibit. I don't know whether you have checked the paper or not. But anyway, if you have checked the other papers also in ACCA, you know how AAA will look like. I mean, how exhibits will look like. Exhibit 1, 2, 3, 4, 5, depending on the question. So, one or more of the requirement. What happens? One or more of the requirement may ask you to relate to a specific exhibit. They will give you the number also. Exhibit 5, Exhibit 6 or Exhibit 4 or whatever. So it's very easy. You easily know for this requirement only this exhibit I have to rely on. So do not waste your time. If the question says use Exhibit 4 for this requirement, use Exhibit 4 only. Don't waste your time going for Exhibit 3, 5 and others. Okay. But some information unfortunately require more than one exhibit, and they don't clearly say which exhibit to rely on, because this gives the tone of the scenario. For example, to understand your client and operation, they might give you financial information, non-financial information somewhere else, some minute of meetings will be given somewhere else, some press release will be given somewhere else. You have to link all this exhibit together, right? So here you can't see how the information relates specifically to the requirement. If something is not relating specifically to your requirement, don't force it in your answer, because you are wasting valuable time. Rather, you can use that exhibit for some other question later on. This is the technique you need to apply in ACCA, not only for AAA, for any paper, even mostly for SBL also. Okay, so that's it for this. Let's summarize everything. We started with the risk and materiality. Risk, business risk means anything that could prevent you from achieving your objective. It could be adverse impact, event, condition, right? And hence, it will have an impact on your financial statement. Next, risk or material misstatement means a risk that financial statement could contain material misstatement. Audit risk, risk that auditors will give an inappropriate audit opinion. Risk assessment procedures are four. You inquire, you do analytical review, you do inspection and observation. Then performance materiality you have set, which is below materiality. Okay, this is a lower threshold and it is applied to testing, which reduces the risk that misstatement in aggregate is material. Okay, so that's it for this lecture. I shall see you in the next lecture, which is the continuation of this lecture, because there I'll be doing 4 questions which are very lengthy, exam style questions only. So make sure that you first go through this lecture before you attempt the question in my next lecture, because without this lecture you will not be able to attempt those questions in that lecture. So see you in the next lecture, and please do not forget to subscribe to my channel if you haven't, and make sure that when you are watching my AAA lecture, you follow the order given. You start with lecture 1, 2, 3 like that. Then it becomes very easy for you to understand AAA rather than just randomly watching from anywhere. And you can always download my lecture. All you need to do is go to my channel, go to the about section. Below you will see there's a link for ACCA material. It is labeled as ACCA material. If you click there, you will get all the textbooks and the revision kit, the Kaplan textbook and kit for your AAA, AFM, SBL and SBR, this 4 subject. And if you want this PDF slides, all you need to do is click the appropriate subject lecture. For example, you want AAA lecture, you need to click AAA lecture. You will get the PDF slide. Thank you and see you in the next lecture.